What's up everybody, Gen X Dividend Investor here. In this video I share a new all-time high of $3 million that my dividend portfolio just hit. I'll also show you a bug in Fidelity I just found, and I'll explain why I've constructed my portfolio in a way that I expect will underperform the market over the long run, which another financial influencer said was stupid to do. Now, even though people constantly request that I do more portfolio reviews, I try to limit doing them to once per quarter because not much changes over small time frames. But hitting 3 million is a milestone amount for me, so I figured it would be fun to share. And hey, lots of people's portfolios are hitting all-time highs these days. Like on the 11th of July, a user on my Dividend Discord named Smoke and Blaze said that his portfolio value leaped into the 29k territory for the first time. Then the next day, Sky1847 also said his portfolio just hit a new all-time high. And all that makes sense because as the market hits new highs, then odds are your portfolio will be doing so as well. Of course, sometimes your portfolio can be sucking even when the market is doing well, and that's just the nature of owning individual stocks. Okay, let's jump into Fidelity. I took this screenshot on Saturday, July 14th. If you're new to my channel, then you wouldn't know that I've been investing for about 3 decades now, and I started from scratch and am a big believer in slow and consistent investing to become wealthy. I'm not going to repeat all the stuff about my background and how I got to this point, so feel free to watch my other videos like what I learned living on dividends for 3 years to hear more details about myself and my journey. Anyway, this Fidelity screenshot shows us that right now my portfolio is at up to $3.07 million, of which about $1.36 million is in my retirement account, $1.53 million is in my taxable, and about $187k is in my wife's rollover retirement account that I manage. I've covered up some things in red like account numbers and non-investment accounts. I also took a screenshot of my accounts using my iPhone Fidelity app, and you can see that the SP500 is over 5600 and it's been doing well for a while, so I fully expect that we'll have a material crash at some point, and I wouldn't be surprised to see my portfolio fall down $1 million or more. Big market swings have always happened, and sideways markets can drag on for years as well, and I believe that as long as you keep investing non-stupidly, then things should work out for you, and no one knows what the future will bring. And as someone who has no intention of selling, then it honestly doesn't matter to me if my portfolio shoots up or down. I've been doing this long enough to know that the likelihood of me being able to correctly time the market and completely sell out and then buy back in is too hard to do and too stressful and too risky for me to try. So I just keep holding my decent companies in my portfolio, and they in turn keep paying me a share of their profits as cash dividends. I use dividends to pay all my bills, and I'm used to stock prices fluctuating a ton, and I'm also used to seeing my dividend income mostly trend up over time. Okay, let's dive into each account, starting with my IRA. This is sorted by ticker alphabetically, and this is my first of 2 pages of tickers in my IRA. It starts with AbbVie, and I have 247 shares of it in this account, and I have about 42 grand of AbbVie, which is a tad over 3% of my IRA, and this says AbbVie's last price, which I think should be its closing price, was $168.73. Anyway, this Fidelity shot shows that AbbVie currently has a 3.65% yield, and my IRA account estimates it will yield $1,531.40 in dividends per year. I currently withdraw most of my retirement account dividends early, which means I paid the 10% early penalty tax for doing so. I strongly encourage you to avoid taking anything out of your retirement accounts unless you're retired or unless you really have to. At some point in the future, I may do a 72T to avoid that 10% early withdrawal penalty tax, but I've not committed to doing that yet for a variety of reasons. Okay, next up is BTI, aka British American Tobacco, which is one of my non-US stocks. Feel free to pause the video if you want to see all the details of each ticker in my IRA, but for now I'll just quickly go over things and then I'll show you a roll-up view of all my tickers in my spreadsheet tool. So after BTI, I have Caterpillar, Colgate-Palmolive, Chevron, and Devo, which is an income ETF. After Devo is Duke Energy, which just announced a small 1.95% dividend hike after I took the screenshot. I actually ran a poll on my Twitter where people could vote for how much they thought Duke would increase their dividend this year, and the majority guessed 2 to 3%, though about 29% correctly guessed that it would be between 1 to 2%. Some investors get understandably annoyed when they see a hike smaller than inflation, but I tend to prefer to look at longer-term trends, as well as look at current yield, pricing movement over time, potential buybacks, and various other aspects, all of which paints a picture of a company in my portfolio. Some tickers I hold have more compelling price appreciation potential, some I hold for lower risk income, some I hold for whatever. Utilities have been looking a bit more compelling to some investors lately as interest rates come down and as energy needs for AI have gone up. Anyway, before Duke's dividend hike, I was making $1,722 a year in my IRA from Duke and was making $4,415 a year in Duke divvies across all my accounts. But now I'm making $4,502 in Duke per year, which is $87 more annually, or about $22 more per quarterly payout. That might not sound like much when taken in isolation, but every little bit matters and adds up to something decent. Okay, and on this first page of stocks, we see that my last ticker listed is Goldman Sachs. Moving on to the last page of my IRA tickers, we see JEPQ, which is another income ETF, and both it and Devo were 100% bought using profits from other tickers. So kind of a free ride with them, and so far they've been outperforming my expectations, though I think they'll get a lot more interesting in a down or extended sideways market. Next up is J&J, Kimberly-Clark, Coca-Cola, McDonald's, Altria, Realty Income, Pepsi, Procter & Gamble, Starbucks, a dividend ETF in SCHD, then Southern Company, Toronto Dominion, which is my other non-US stock, and then ExxonMobil. So in total, we see that my IRA is at $1.356 million worth of stocks, and Fidelity estimates that it generates $58,010 a year in dividend income. Note, since I've had my retirement account for about 30 years, it's been able to compound and grow to this point, which is why its total is more than the normal annual max contribution amount would be. These days I'm reinvesting some of my SCHD, JEPQ, Devo, and Realty Income dividends back into themselves. Speaking of O, you can see that my Realty Income position yields $8,619 a year of dividend income in my IRA, and across all my accounts I'm making $11,331 per year of O, and I have a goal to make $12K a year or $1K per month in it. Given O's smaller dividend hikes these days, coupled with the small amounts I'm reinvesting, I'd imagine it'll be a year or two before I get to my goal, so it's kind of unfortunate that O's prices started trending up lately, as I'd rather it keep going down while I'm accumulating more. Regardless, O's price looks pretty cheap to me right now, so I'm happy to keep buying, and in a moment I'll show you how even small investments can compound nicely over time. Moving on, we come to my taxable account. You'll find that I sometimes hold the same ticker in multiple accounts, often to give me more flexibility to buy when I want to. So here on page 1 of 2 we see Apple, AbbVie, BTI, Colgate-Palmolive, Chevron, Duke Energy, Enterprise Products Partners, and MLP, which means their dividends are actually called distributions, and then we see J&J, Kimberly-Clark, Coca-Cola, and McDonald's. And moving on, we see Altria, Microsoft, Realty Income, Pepsi, Procter & Gamble, Philip Morris, SCHD, Southern Company, and ExxonMobil, with a total account value of $1.527 million, which yields about $61,798 a year. Moving on to my final account, we see AbbVie, BTI, Home Depot, J&J, Altria, Realty Income, Toronto Dominion, and Travelers Insurance. This last account has $187,000 worth of stocks in it, and it yields $7,668 of dividends per year. So in total across my 3 accounts, Fidelity estimates that I make about $127,500 in divvies a year, which is a bit less than the $128,000 my spreadsheet estimates, due to how I dynamically factor in currency changes, along with how I estimate go-forward ETF payouts based on up-to-date trailing 12-month ETF values. Okay, and then this is a view Fidelity provides that shows all your account activity over a period of time, which in this case is the last 30 days. One interesting thing Fidelity does is it starts processing dividends earlier than the day they pay out, especially on weekends. So even though I took this screenshot on the weekend, you can see that it shows 3 Realty Income dividends coming in the future on Monday, July 15th, i.e. its actual payout date. The first O divvy it lists is in the Rollover account, and it'll be for $192. The next is in the Taxable for $33, and the final and largest payout comes in my retirement account for $718. Dividends become withdrawable in Fidelity for me around 9 p.m. Pacific on the payout date, though I can seemingly reinvest them earlier than 9 p.m. I've set up my taxable account to automatically transfer all dividends I receive to go directly into my checking account, and those divvies usually show up 1 to 2 business days after the pay date, so I saw my small amount of taxable O dividends on Wednesday in my bank, and I manually transferred my IRA O divvy cash out Monday night, and it showed up in my bank checking account on Tuesday. For decades I only had O in retirement accounts due to it not being qualified, but I recently established a small position in my taxable as I wanted to test a few things out and give me more buying flexibility. You can also see that on July 12th, $2,795 of Altria dividends transferred out of my taxable account and were dividends that first showed up on July 10th. I also got $417 of Altria in the Rollover account and $510 in my IRA. On July 8th, I got $863 from Philip Morris in my taxable, which I also transferred out. Okay, now let's jump into my spreadsheet tool to see some more details about my portfolio, and I've sorted this based on largest positions on top. Feel free to watch my previous videos if you want to learn more details about my dividend spreadsheet. At a high level, we see that in total my 28 tickers are worth about $3.07 million and they generate $128K of dividends per year. You can see that on the day I took this screenshot, my portfolio ended up 0.68%, which means up almost $21,000. I like to be pretty much fully invested in equities at all times, and I'm not interested in selling, putting my cash in the bank or in CDs or in treasuries, even if those yields have been more compelling than usual, as I found that over the long run I do best by buying and holding and reinvesting. And yes, I could obviously generate more divvies if I moved my lower yield things into higher yield things, but I've crafted a portfolio to meet my needs and risk tolerances and timelines, and you shouldn't copy what I've done as everyone has their own realities. My portfolio's current starting average weighted yield is 4.16% and its 3-year dividend CAGR is 5.62%. And I'm not showing it on this screen, but my average weighted PE is 21, which tells me things are probably a bit expensive right now, since I feel a 15 PE is more of a reasonable market average, even though there are periods of time when things average higher or lower than that. Like during the last 15 years, with the exception of the Great Recession, the PE ratio has been generally centered around the average of 19-ish, but from 1973 to 1985, the PE ratio tracked close to 10x. Right now, the market average PE in the S&P 500 is more expensive at like 24, and I'd also expect that as interest rates fall, then many divvy stocks will get more upward pricing pressure, though I'd also expect overall downward pressure given average prices. But hey, you can't predict the future, and I also wouldn't be surprised to see things like AI to continue to rally the market. Anyway, my portfolio's average weighted beta is a nice and low 0.56. Sometimes people ask me why I like a low beta portfolio in retirement. Well, number one is because that often means reduced volatility. You see, low beta portfolios are generally less volatile compared to the market, which means that my portfolio tends to experience smaller fluctuations in value, providing a smoother investment experience and less stress due to probably falling less when things crash. And a higher beta portfolio can sometimes mean more growth, so depends on what you want. Another reason is related to number one and is a risk management reason. Basically, by holding a low beta portfolio, investors aim to minimize their exposure to systemic market risk. This is particularly important for risk-averse investors or those with financial goals where preserving capital is more crucial than achieving high returns, which is the boat I'm in. And number three is for stable returns. Low beta portfolios are often composed of stable, mature companies that offer consistent returns. These types of companies tend to have established business models, predictable cash flows, and dividend payments, which can appeal to investors seeking reliable income streams like yours truly. Number four is because having a mix of differing beta stocks aligns to my diversification goals for my portfolio. Number five is because I like to be more defensive, and during periods of economic uncertainty or market corrections, low beta portfolios tend to outperform high beta portfolios. Plus, low beta portfolios often include defensive stocks, such as utilities and consumer staples, which tend to perform better during economic downturns and periods of economic uncertainty, all of which I like. Number six is behavioral in the sense that I like the peace of mind that comes with less volatile investments. So TLDR, a low beta portfolio aligns with my investment goals as I like more stability, capital preservation, and reduced exposure to market volatility, along with boring proven companies which continue to pay their shareholders in tough times. This way I'll get some upside, but probably not as much as the overall market, and then I'd guess I'd have less downside when things crash, and all along the way I'll get more passive dividend income. And all that actually takes me to a statement I recently saw on Twitter. Basically, someone was saying that you should always try to aim for the best total returns, and doing anything else was stupid. I thought that was an interesting comment to make by a financial influencer because they seemingly aren't realizing that different people have different risk tolerances and timeframes to meet their goals and needs. Like the reason why some people put money into CDs or treasuries is often because they want a more guaranteed return, even though that return will probably be lower than if they risk it in the market. When I was younger, I did indeed prioritize total returns over anything else, but as I got older I started wanting some more safe income, and so utilities became more compelling, even though I didn't expect them to have the price appreciation of a Microsoft or whatever. You sometimes may want tickers that have lower risk returns, or perhaps shorter term returns, or perhaps you want to be in more diverse asset classes, or there are a slew of things that may go into your investment decision making. So yes, total returns are often a primary objective for many investors, but the reality is that there are several other considerations that go into investing that might push you away from only focusing on total returns. Like retirees often care more about capital preservation, so they might seek out more low risk stocks, knowing that they probably won't appreciate as much. Some people might not invest in certain companies or industries because of what they do or make or whatever, even though those companies might yield them more in total returns. And some people might choose to focus on large cap proven stocks because they're cool with decent returns, even though smaller cap stocks might have more return potential, but coupled with more loss potential. Some people might choose to hedge their portfolios in a certain way that has a short-term return cost to doing so. My point is that there are a ton of reasons why people might invest for things beyond just total return, though obviously total returns are important. But so is your risk tolerance, your values, your long-term objectives, your current financial situation, etc. So like I've explained why I like a low beta portfolio in retirement, something that I expect will underperform the market over the long run, but it'll also enable a bunch of other things that I want, so I'm cool with it. Okay, back to my portfolio. Let's zoom in a bit, and I'll just go over the top 5 positions, but you can pause if you want to see more details. We see that SCHD is currently my largest position and is 6.92% of my portfolio and is worth $212,000, and it generates about $1,900 a quarter or $7,600 a year. Next up is Realty Income at $200,000 worth, and it generates $944 a month or about $11,331 a year. Then I have Altria worth $181 grand, and it yields about $14,900 a year. I'm guessing we'll see a dividend hike announcement from MO in the 4 to 5% range in the upcoming weeks, so that'll probably boost my annual dividend income by another $600 or $700. Next up is a super low yielder but high grower in Microsoft worth about $170 grand, and which yields only about $1,100 a year. Then I've got AbbVie at about $159 grand, and which yields about $5,800 a year. Then we see JetQ followed by J&J. Then EPD, Devo, Exxon, Procter & Gamble, Pepsi, Duke Energy, and Coca-Cola. Then McDonald's, Apple, BTI, Southern Company, Goldman Sachs, Kimberly-Clark, and Chevron. Finally, Philip Morris, Caterpillar, Colgate-Palmolive, Toronto Dominion, Home Depot, Travelers, and finally Starbucks. Moving on, this is a view of my dividend income over the last 6 months as well as estimates for the next 6, sorted by my largest positions to my smallest. The middle green column is the month we are in, so July, and to the left of it are the last 6 months of actual dividend income I've received, and the columns to the right of it is monthly dividend income I'm estimated to get based on current dividend amounts. The realty income row is a good one to look at to see how small reinvestments can add up over time. Like I'm only reinvesting $200 of O each month out of the $900 and something I get, so any increases you see month over month on this chart either came from that small reinvestment or from any hikes that happened. So in January I got $915 of O, then in Feb I got $916, then in March $917, then April $919, then May $920, then June $941, and I'm expected to get $944 this month in July. And I love seeing dividend income trend up like that. Sometimes companies will do smaller hikes, like O is doing right now given the various economic concerns, but good companies generally can just weather the storm and keep increasing, usually at a faster rate than inflation. Anyway, I'll be stoked once my O income is over $1,000 a month, especially because I don't need to deal with renters, or approving a new HVAC unit, or dealing with someone who fell down on the snow in my driveway, or deal with some hazardous material leaking onto my property, or whatever. All stocks have risks, so just because I'm buying doesn't mean you should. On the bottom of each column you can see the total dividends I got for that month, so like in Jan I got about $9,300 of dividends, then $9,900 in February, then $10,900 in March, $10,200 in April, $10,200 in May, $10,600 in June, and I'll get about $11,400 this month. Then I'm estimated to get about $10,300 next month in August, then $12,400 in September, then $9,300 in October, $10,300 in November, and $10,500 in December. And since I'm slowly reinvesting, and because companies are usually slowly hiking, then my future 6 months of income often tends to be higher than my previous 6 months. And note, sometimes quarterly payers don't pay out exactly in each quarter, so like Coke and Pepsi and SCHD and such can sometimes vary a bit, and my spreadsheet tries to estimate future payouts, though it isn't guaranteed to be accurate as no one knows what companies are going to do in the future. Okay, and then here's a view of my actual dividend income I've received since I started this new spreadsheet product about 4.5 years ago. You can watch a video I did years ago called The Time I Sold All My Stocks to understand why I don't have my dividend data going back multiple decades. Regardless, I love how this dividend income trends up nicely over time. Moving on, whereas my last screenshot was actual dividend income, this new one shows what my estimated dividend income would be if my recent historical dividend hikes continued into the future. The top line is the no drip line, which means it estimates what my dividend income is per year, assuming I'm spending all my dividends, which is pretty much what I'm doing now that I'm retired living on divvies. And the bottom line is the reinvestment drip line, which means it estimates what my dividend income would be if I was reinvesting all my dividends. My guess is that I'll end up somewhere between those two lines as I'm reinvesting a small amount, though if a company lowers their dividend then obviously those numbers would go down, and I'd probably sell out of that stock and go into something else. So if we look out 10 years, it estimates that my portfolio would be yielding about $221K a year in the no drip line, or $318K a year if I was dripping. And note, this assumes a 0% inflation rate, but I have an input field which lets you model how different inflation amounts could impact your buying power estimates over time. This also shows you that I make about $10,650 a month in dividends on average, or about $24.50 a week, or $350 a day, or $14.59 per hour, every hour, year round. And this shows you how the Dow and S&P 500 performed each day, and in this case my portfolio outperformed on that day as I was up 0.68% like I previously showed you, which is more than the 0.62% for the Dow or the 0.55% for the S&P 500. So again, I've created a portfolio for retirement which tends to go up less on up days, but also down less on down days, but sometimes it'll outperform, and sometimes it'll underperform. Moving on, here's that drip no drip data in graph form, and it shows you how reinvesting your dividends in red can make your dividend snowball compound faster. And then this graph shows compounding over multiple decades, and it really makes the point about how powerful compounding becomes. Then this is a graph of portfolio value by sector. So like consumer staple stocks are 16.5% of my portfolio, technology is 13.4%, energy is 11.6%, ETFs are 11.4%, etc. And then this is my annual passive income percentage by sector. So since stocks are almost 21% of my income, energy is 14%, tech is 11.4%, etc. And I think that covers things. Please leave me a comment telling me if you'd like me to do more portfolio updates, less portfolio updates, or about what I'm doing. And thanks for watching and commenting, I really appreciate it. I'll close this off by recommending that everyone consider using my FASTgraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment even if they sign up for a full year. I'll also recommend checking out my Seeking Alpha affiliate link, as new users can get discounts for signing up. Plus, take a look at my Patreon seats to see if there's any that you want to sign up for, but since my Patreon, Aristocrat, and King seats are usually sold out, I'll also recommend that you join my channel membership, which gives you a variety of perks, including a badge icon that is placed by your comments on my videos and which levels up over time as long as you're a member, and you get the ability to vote on which thumbnails I use for my next video, and you get to watch my videos about a day before I release them publicly. But whatever you do, please hit that thumbs up button, subscribe if you haven't yet, and click the bell notification. And don't forget to join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 81 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.